Today's sell-off was a bear trap until proven otherwise, and I've got some data points to support that claim. But I'm also sensible enough to understand that not everything is fine and dandy out there with the massive rally we've been seeing in interest rates, notably the 10-year yield over 4.2%. So welcome to the Trade Brigade Midweek Show, where we'll take a look through all of the data points and build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got one additional trade idea to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off with a closer look at the SPY daily time frame chart. What do we see here from a trend perspective? Of course, massive lows anchor the trend back here. This is a set of higher lows, and it's very possible that the low of today's session just acts as the next daily higher low in the trend count. It's worth reminding ourselves that we are technically pulling back from the highest high in the trend count, meaning that we can afford the higher low. It's not like we're pulling back from a lower high, and we're pulling back from the all-time high as well. I'd also like to point out that this is the ideal location for that daily higher low over the previous quadruple top highs now starting to act as support. The reason I would say we're already starting to see support, of course, is just noting the daily structure here. We've got ourselves a daily hammer candle, right? There's a longer, lower wick. It's about half the size of the candle range that we're seeing here. We've closed in the midpoint of that candle range. So I'm not going to sit here and pound the table and say, oh my goodness, this is the best looking daily bar I've ever seen. But there is a strong response from the buyers off of this very technical level here at 574.40. So for that reason, I don't really think there's anything stronger to say about big momentum sellers entering this market. If we're thinking about what we argued for in the weekend video on Saturday, it really brought in the 20 SMA here on the daily time frame. So let's pop that on. If you recall, the argument was, hey, after a big breakout, it's not really all that unreasonable for price to consolidate until the 20 SMA catches up to price, or if there's a pullback, if we can hold over the 20 SMA, that would also be ideal. So when we were describing those outcomes, we were talking about this balance range up here saying, hey, wouldn't be crazy if the 20 SMA slowly creeps up, and maybe when there's confluence, that acts as the next launching place. Now, there's nothing special about the 20 SMA. It's not the holy grail indicator. All it would sort of suggest is just that the market's no longer as overextended, air quotes on that one, big time, right? Overextended is a very subjective term in the market. The market's not as overextended as it was trading near these highs. We've traded back down into a reasonable reference point, notably the structural element that we've just talked about. And what happened there, right? Did we close under the 20 SMA? No, we closed above the 20 SMA. We closed back inside of the weekly expected move. So I do like the response that the buyers are coming up with currently off of that 574.40. An alternate take here is possibly throwing on the rising wedge that everybody and their sisters, brothers, mother is talking about. If you use this as an anchor point, using this as touch one, this is exactly the low of today's session. We have not technically broken the pattern here. I would not call this a bearish breakdown of the rising wedge. It's just another data point here to carry into the analysis. Let's bring it on down to the hourly time frame chart by flipping screens as such, and we'll dive a little bit closer into the data points from today's session. So the first hourly bar, I just want to point out that we opened in range in value, and in the first hourly bar you can see that the lower wick actually did support inside of this overhead range. So it's not like it was just pure play selling right out of the gates. It did take some time to sort of materialize. Now, once we broke underneath that, you can see the third hourly bar of the day does produce an upper wick rejecting 579.75. So to me, that'll continue to be a key level as we move forward. I would say for the most part, the daily time frame and higher traders are really looking for this to be respected as a daily higher low, and over time, we're looking for a move back to the highs. If you're a more nuanced, shorter term trader, then absolutely, we just want to be focused on this level right here, 579.75. There's 100% the opportunity, at least, for some kind of rally into that level that potentially rejects. We're not there yet, but it's a possibility, right? If we reject there, that of course produces a big time hourly lower high. Trading into the equal low then jeopardizes that daily higher low that we were just describing. And again, this is just one possible path here. As we take a look at the after hours session, you can see the bid-ask spread up here is somewhere closer to 578.73 by 79, meaning that we're trading closer to that level. There's a little bit of a gap up taking place right now in Tesla after their earnings report was released. We'll get to that chart in just a moment, but I would be expecting some upward pressure so long as that gap can hold out of Tesla, meaning that once again, tomorrow morning, it's probably all about 579.75. If we reject underneath, then okay, I'm open-minded to an hourly trend reversal, sets of highs, rejecting the balance lows, offer a lower high, looking for at least an equal low. From there, we'll have to re-evaluate whether or not there's a breakdown. If we can recapture that level with a higher low Brigade bolt above on the hourly time frame chart, this is a very classic example of look below and fail, right? Here is a balance range. You look under the balance range, the sellers fail to materialize and produce momentum to the downside. Buyers pick it back up for longs on the first show of a higher low over 579.75 to retarget the all-time high and the top end of this balance range. So that's certainly a top of mind priority here as we head into the remainder of this week. So once again, to simplify things here with our pathing, I would argue that this white path here is neutral. I would even argue that this could potentially turn into a double bottom over a longer span of time. If the bears are going to take control, you need to see some sort of either rejection here for a risk reward scalp to the downside. This is a scalp here on the dotted red line. Things might get a little bit more dangerous to the downside if we look like this. Lower high acceptance under that 574.40, and the bulls are totally back on their high horse if we can get something that looks like this for the look below and fail that we had just outlined. Once again, your key level that I can see here on the hourly chart based on this interaction off of the morning session, based on the previous lows here and the breakout highs from Friday of now 2 weeks ago, this is absolutely the number. 579.75 must be a top watch as we head into tomorrow morning's session. If we quickly take out the Fibonacci's just to remain somewhat congruent in this analysis as well, up to the highs, recall that the 61.8 was not cleanly aligned with the daily high or low line in the sand. However, you can just see that we looked at or near it, looked below it slightly, then closed back above. The 38.2 is better confluence with that key watch we were just talking about at 579.75. So recapturing that puts us back into bull flag consolidation territory from this perspective up here. One final study on the intraday time frame chart is, of course, our anchored VWAPs, reinforcing 579.75. It's just so clear at this point where if you reject this, then sure, overhead supply is weighing on price. If you can recapture it, you're back above a key moving average from the origin of the original breakout in the first place. Let's get some more data that really supports whether or not this was a liquidation break, whether or not it was a bear trap, what's going on here with the market internals. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. What do we see from a volume flow perspective today? I mean, definitely outflows from the market, but were we substantially outflows from the market? Were we seeing those substantial outflows? No, we were not underneath negative 300 million. I mean, yes, they're getting there on the week. Recall that 500 million is the net flow on the week that you're looking for a substantial read there. We're not there. We're shy of that at 387 million right now. If you take a look at the previous days of consolidation, really the Monday liquidation break and recovery, the rally from the Tuesday session, none of those days were severe volume outflows. I'm not going to sit here and argue that they're, oh my God, so impressive to the upside. Neutral on Tuesday, still technically out of the market on Monday. But what do we know about the market on Monday and Tuesday? If we just go back to the hourly time frame chart, it's as clear as day. You're just in the midpoint of that balance range. So you can't really read into the internals when you're just getting neutrality from the market, right? I would say maybe there was a small bearish edge noting what happened on the Monday session, but nothing overwhelming. If we take a look at the market internals on the advanced decline line from today's session, yeah, some more severe selling pressure getting near trend lower zone, but it's not like we spent all day just flatline down here. Recall that the strongest moves out of the advanced decline line, if I just grab a couple more days here for some examples, like this is a really strong up day where it's just flat, it opens up there, it's sideways. Really strong down day would be the opposite of that. We didn't really have that on today's session. Of course, because the selling intraday was fairly severe just in terms of the magnitude that we moved, yeah, the index score intraday, that's an intraday indicator, was reading negative. If we look at the cumulative builds, it was negative as well, closer to that negative 5,000, negative 6,000, so substantial reads there. Generally speaking, my main takeaway from the market internals read is just that the volume flows don't really support it. To me, it would seem as though there's more concentrated selling in some of the heavier weight components of the market versus a broad-based sell-off. And I think another piece of supporting evidence here, as we're considering that, is just the performance of the sectors on the day, right? Typically a very strong down day in the market, there's nothing that's going to be green here. Every single sector is going to be red from the open, especially some of your heavier weight sectors, right? The XLF, not a massive outperformance here, but still technically up 2 basis points on the session. It's not really indicative of, oh my goodness, sell everything. We've got to get out of all positions and go to cash or even start shorting the market actively. Not the case. Daily uptrend, hourly pullback, Seems like we're getting a daily higher low. The internals are not blood red, not as bad as they could have been, noting these volume flows and also tying in the sector analysis over here. Just not seeing all the evidence that this is anything more than just a bear trap as of right now. So we'll reevaluate. We'll definitely change our tone if, once again, we get this lower high rejection and the equal low attempt. We're just not there yet. And my first thought would be, okay, with Tesla earnings going somewhat well so far, I would look for at least a test of this on the upside first, reevaluate on tomorrow's session. 579.75 really holds the key, in my opinion. It's the bottom end of the overhead range. Speaking of different ways to look at this range, let's take a look at the market profile. If you're not familiar with the market profile, check out the video tutorial in the top right-hand corner. Of course, this is the long-standing balance range. Notice that value is practically unchanged. So here's Friday, here's Monday, here's Tuesday, a little bit of a move to the downside. It's drifting to the downside, but it's unchanged inside of the overall range here. Notice that the value area high, right here, is the bottom end of the range, which ultimately is that exact level. On the SPY chart, we were just talking about the 579.25. Here on the ES futures, that level is going to be closer to the 58. 58.55, 58.56 is going to be the level that we're going to start carrying forward here. It might be slightly underneath that. We've used 58.52 as the level from the pre-market show, right somewhere in here. Gets kind of interesting as well, especially because we know that 58.92 was the key level overhead. So sticking with those themes of ending in twos, 58.52, value area high. If we can get over that level, you're just back in the balance range. I would look for value to progress in the upward direction to be a confirming indication that, hey, it's very likely that we're going to continue this push in the upward direction. Notice that the point of control did not migrate all the way lower with price. So as we start thinking about more indications that potentially suggest that, yes, this is just a bear trap. Well, first of all, point of control is literally at the halfback of today's session. It did not migrate lower with price. There's a beautiful volume taper happening down here, meaning that we had good excess at the bottom end of the auction. J period single prints confirm that. Volume taper confirms that. And what do we notice about the tippity top of the move? C period technically marks a poor high here with A period, meaning that the auction is incomplete at the highs. Therefore, if we were to test the high, I would expect some sort of break through that level to repair the structure, and then it becomes all about, is the higher low pullback, if that breaks takes place, is the higher low pullback over sort of the value area high and the bottom end of the balance range that we've just been referencing, right? So overall, just zooming back out, these lows from back here, do we stay over this level? So repair the poor high, does the pullback hold? So something that looks like this, pullback, as long as it's over the bottom end of this balance, great, bulls are in control. If we break and repair the poor high, come back in, lower high, and break to the downside, much larger concerns. You could probably play, just because the range is so expansive from today's session, you could probably play an 80% rule trade, which just means if you close two 30-minute sessions inside of the value area here, you're probably looking for a rotation from value area high all the way down to value area low over here. It's a possible bearish setup, but once again, it would require the repair of the poor high first to then trigger that trade. So a little bit more nuance here in today's episode on the market profile, but let's get back on over to the platform and do what we do best. We'll move this show right along into the nasty NASDAQ QQQs on the daily time frame chart, and we'll see what else we can learn about the other sides of the market here. So in terms of the NASDAQ trend, I mean, it's still certainly in the upward direction. You have lows, higher lows, and we are right at that daily line in the sand that we've called out from the weekend video. I know there's a lot of levels baked in and around and near that, but it's 486 is the key number that we need to hold above. As of right now, it's not as pretty as the S&P daily time frame chart, especially the bar here. You are getting a lower wick produced at and near that level, but it's not as meaningful as the S&P. I like the fact that maybe there's a little bit of an undercut here, giving the sellers the opportunity to push more aggressively to the downside, and they are unable to do so with, once again, a close back above that key daily line in the sand. Once again, that's 486 as a number. Lots of little levels in here that we'll see on the hourly time frame chart, but one thing I do want to call out is that this balance range right here, it's really a 3, maybe 4 day balance. That's going to be your rock and a hard place for the QQQ. So it's between 486 and the bottom end of that range here at 491.25. If we can get over 491.25, I would start thinking about continuation to the upside. If we are under that level, to me, you start to get a little bit of it's kind of a stretch here, so bear with me, but you have left, maybe a head, maybe a right shoulder starts to emerge. If we stay stuck underneath that 491.25. So we'll take that in stride. As of the post-market, with Tesla earnings going so far so good, we have 490.21 by 35, meaning that it would be very reasonable to get some sort of test and an answer on tomorrow's session as to what will happen here at 491.25. So not much to read into on the daily analysis. Let's throw on the 20 SMA to be congruent here and see what's going on with that. We did technically test and close underneath, unlike the S&P 500, which, as we just saw, closed technically above, but we're still over that daily line in the sand. And once again, I want to just call out to reinforce the idea that the 20 SMA is not a magical indicator. It just sort of gives us an idea of whether or not the market's extended, how long this trend has been going on, so on and so forth. So not the worst indication in the world, but it's maybe one minor bearish data point relative to the S&P. If we bring out the alternative drawing set, which of course is that same rising wedge, notice that you are still supporting off the bottom end of that as well. Support, and support here in the lower wick from today's session. Info box looks like it's stuck on over here. Let's jump on down to the hourly time frame chart, where once again we can see the same interaction basically. If we're thinking about this as a balance range, first hourly bar lower wick supports, third hourly bar upper wick rejects. So 491.25 is that key level. It's the bottom end of that 4, maybe 3-ish day balance range that we were just referencing in here. If you get a rally upwards, you're looking for potential rejections off of that area. If you're looking for the bearish outcomes, you'll trade for the equal low down at 486, that daily line in the sand. When we get here, I would say this is the caveat to take away. If you're looking for a short in the market, I would say that this equal low down here is far more dangerous in the NASDAQ side, the QQQ, than it is with the S&P 500. Why? Because you've already gotten this sort of high, deeper pullback, could not rally to an equal high, whereas the S&P is almost directly pulling back from the highest high in the sequence after this gap up on a relative basis in the S&P. So for that reason, once again, I think that this is kind of an idea that's a bit stronger for the short side out of the NASDAQ. It would sort of be my secondary idea. I think that the primary idea should be, okay, trade for this, look to see if buyers step up again. Maybe this turns into a larger double bottom, or if we rally and recapture, just like the S&P 500, I think we have a classic example of a look below and fail. This higher low here should be traded with risk reward along these lines, back up to the top end of the balance, possibly looking for continuation to balloon some runners into some better R multiple trades there as well. So generally speaking on the NASDAQ, I do think it's still kind of a liquidation break to the downside. I think it's kind of still bear trappy to the downside. I'm not totally convinced that we have a full-blown trend reversal. If we take out the intraday anchored view apps, we can see where we're at from this perspective, once again reinforcing that over time these will start barreling down, early tomorrow morning, right around this 491.25 area. You could even bring this back about 2 days, I believe, if we just take 2 days off this to the 15th was the gap up day, or sort of this high open. It's just still confluence with that area. So over time, over the next couple of hourly bars, it'll slowly drift to the downside so long as price is below those anchored view apps. So makes sense, all set out of that. We'll quickly check in on the Fibonacci's from the bottom end of the origin up to the top of the high. And in this case, we did close underneath the 61.8. The 38.2 is not even within striking distance. So once again, I think that this aligns with the idea or the concept that if you're looking for stronger short opportunities, the NASDAQ is the weaker of the two markets right now. And of course, to some degree, you're seeing that because of the lack of inclusion of financials in the NASDAQ, right? So with that kind of understanding, you have the key levels, you have our thoughts here on the NASDAQ, weaker than the S&P with key levels, 491.25. How many times can I say it, right? Let's jump on over to the NASDAQ market internals. And we'll take a look over here. So confirming everything we've said, weaker market, definitely stronger volume outflows, underneath trend lower zone intraday out of the advanced decline line, and a really strong negative cumulative build here. You actually saw a really strong build to the downside on Monday as well. Typically, you're looking for negative 6,000 on the cumulative tick out of the NASDAQ side. These are negative 9,000, getting very close to negative 10,000 on Monday's session as that sort of little break and then recovery rally took place. It really wasn't all that strong at the exchange level, noting what was happening here with your ticks, right? It was really that NVIDIA push to new all-time highs and that consolidation up there. And then we had Microsoft save the day on Tuesday. So you had a couple of saviors, but now that those have stopped performing, you are getting bearish internals here on the NASDAQ in particular. I'd say the S&P is, again, still slightly stronger, and it's still just kind of looking like a bear trap on the S&P side, not as much over here on the NASDAQ side. We will take a look at the market profile for the NASDAQ and see what's going on here. So same idea, right? Balance range, you're seeing value is unchanged today. Notice, and again, this is a key difference between the NASDAQ and the S&P, see, value is shifting lower, but the point of control is notably lower. The point of control in the S&P 500 closed at the midpoint, half back of today's range, right? S&P point of control was here. NASDAQ, much lower. You are still getting a volume taper down here, but it's almost like we have a double distribution with a very small string of single prints in F period that distinguish the upper distribution from the lower distribution, and the point of control did migrate to the lower distribution, the midpoint of the lower distribution, but that, of course, is inherently bearish more so than bullish. If it was going to be more bullish, you would expect the point of control to do more business up in this area, not quite migrate underneath the entire balance area as a whole. You do have a okay high. I'd just consider that it has a lack of material excess up here instead of, it's not a good excess high, but there's lack of material excess, but it's also not a poor high desperately in need of repair. So for that reason, I think the NASDAQ market internals and market profile really suggests that, once again, in alignment with the QQQ analysis, this is the place to be short, not necessarily your S&P 500. Let's finish up the broad market ETFs with our Russell. Let's jump on over to small caps. Of course, very sensitive to the interest rates and financial conditions as of right now. However, even taking a pretty, standard technical approach to this chart, what do we see from a trend perspective? Lows, higher lows, higher lows. It's very possible that this is a higher low. It's not the cleanest hold of the key level. I want to be very, very clear about that, right? This is a close right at the key level. We dipped a toe under the key level. The NASDAQ closed over the key level. The S&P 500 kissed the key level and closed well above, right, without even having that undercut. So I do think that the IWM, it's a technical higher low, but it's not really as pretty as we would have liked to see it, staying over that 219.25. That is the key level for the higher low, noting that this balance range did break out and it did make a higher high in the trend count. You can't really afford to get too much price acceptance in here. Otherwise, this starts to look like a failed breakout. Consolidation in here builds out a right shoulder lower high. And suddenly the next thing you know, you're breaking down through the weekly line in the sand for a thin structure retracement back over here. So I think you're treading on thin ice out of small caps, if I'm being quite frank, which aligns with the technical story, or the fundamental story, I should say, when it comes to evaluating the 10-year interest rates, which we'll get to in just a moment. So daily hammer, yes, closed right at the key level. Ideally, this promptly gets acceptance back up and into the weekly expected move. Notice how we are extended through the lower bound of that. So the best weekly close that we could see here, if you can imagine the weekly bar so far looks something like this, right? We want to see that morph into a stronger hammer candle. Maybe something that looks like this on the weekly bar would be quite convincing that, okay, maybe this is a higher low in the trend sequence and we can look for upside. If we close really weak down here and we get like a solid red-bodied bar, start to have some pretty big concerns about, once again, the bigger flush underneath that 215 level, getting us underneath this overhead chop really established by this balance range from back in the past. So small caps, they've got some work to do. I'm not sold on the idea that it's hell in a handbasket, but it also doesn't look fine and dandy, as we had noted in the intro, for the lack of a better term. We could throw on the 20 SMA. Obviously, testing the 50 means that you're underneath the 20 likely, unless they're paired, which they're not. So you rejected that sort of at the highs. The day to hold it would have been Tuesday, not even close to a hammer high break on today's session. So generally speaking, as we've noted, there's some work to do here. I don't think we have the alternative drawing set brought up. Let's just try it on a clean drawing set real quick so we can test this out together. Let's come in here with a trend line. There we go. So you're still over this technical trend line, and what do we see if we connect some of our highs in here? This is just sort of why I don't overly rely on trend lines. Do you have something going on? Maybe. I don't really think it's a strong argument. So for that reason, let's just move along to the hourly. What do we see over here? A lot of the same. Support off the daily 50 SMA, sure. Kind of a close right at that key level. You are still seeing the lower wick of the first bar, upper wick of the third bar, and sort of the end of day close. So just reinforcing 219.25. If we can stay above, it's a step in the right direction. The strongest break would be something that looks like this into the end of the week out of the small caps. If we can get a Brigade bolt over 221.75, great. Bulls are back in control. I would argue that we want to be leaning long in the S&P 500. If we start to get any rejections below that level and making new lows down to here, as we called out on the daily time frame chart, this gets pretty dangerous underneath these lows. There's some pretty thin structure all the way down through this. This is where I would not rely on the trend line, just FYI. Let's put this, let's put the other drawing set back on. Through here, you're probably talking about a retest to this breakout level. Let's go back in here with the proper tools. Some real-time analysis for you. Hopefully you guys don't mind this stuff, my ranting and raving about the trend lines and putting these in real time. There we go. All right, so you'd be thinking about something like 208.75. If you break these equal lows, kiss it goodbye, thin structure retracement, that's obviously going to be a big headwind for the S&P 500. With that, I think we're all set on the hourly. We could throw on the intraday anchored view apps just for the exercise of doing so, kind of reinforcing that this might be a tricky spot to get through. This might be a little bit optimistic with all of these anchored view apps barreling down on price. And if we bring out our Fibonacci from the bottom of the move here, up to the top, you can see that this line in the sand, the 61.8, has been violated. We closed right at it. Any further price acceptance below dramatically increases the odds that we are going to get that full 100% retracement to the weekly line in the sand, 215. So small caps posing a threat to the S&P 500 is really the bottom line out of this analysis. Let's jump on over to the Russell market internal, see what's going on from this perspective. You can see that we did not really have severe volume outflows on any day this week. You're getting some, close to trend lower zone move on Monday. Wednesday, today you're sort of staying above that area, you're out of the woods. I'd say the NASDAQ is the place to be somewhat most concerned based on the performance of the index in aggregate, or the exchange for the NASDAQ in particular in aggregate. So with that, we will move along to the market profile of the Rusty Rut. We'll see what's going on over here. And if we take a look, I basically just want to see where value is relative to the breakout bar from back over here. Remember that this is a P-shaped profile. If we do something that looks like that, point of control is underneath. It is a normal looking distribution, sort of a bell curve, if you will, with decent excess at the low, great volume taper. So I think that the key is, I know it sort of sucks to push it off day by day by day, but it really seems like the key is tomorrow. For tomorrow's session, does the Russell get up and over this key level? Like, closing on the level doesn't really give us the information that we need. If we closed below, it's like, okay, great. We look for rallies to reject and offer lower highs. When you close right at the level, it's like you got sort of to look for this and you've got to look for this. So your Russell pressure and whether or not it's going to be a head or a tailwind for the S&P is yet to be determined based on the open tomorrow morning. I would say even if it does rally, I'd be slightly concerned about the amount of resistance we have overhead with these anchored view apps, and noting that there was more of a severe sell-off taking place here with the liquidation break on Monday morning. No response off of this, really just more so sideways, consolidation, digestion, no response from the buyers on Tuesday, right? Think about it. All the buyers had to do to put a short squeeze on would have been up and over this level here, not even close. Could not, opening drive to the downside, hardly made it back to the high of day for the close, and today speaks for itself, right? So we've got some headwinds here in the Russell small caps, but let's get back on over to our core indications for the S&P 500 by looking through the weekly performance of our sectors. Leading the pack by being down the most here in our flipped upside down performance grid is consumer discretionary, down 2.52%, followed by materials, that's lighter weight, industrials down 1.83%, the third. If we take a look at the bottom end of the barrel by being down the least, we see utilities, real estate, and consumer staples. I will give some credit where credit is due. I mean, technology sector, XLK, it's not like it's beat up all that bad, only down 76 basis points. Semiconductors only down 79 basis points. You're not seeing like a huge risk-off style posture. It'd be one thing if the tech and semiconductors were down 3% or so, but you're just not seeing that. So once again, in the S&P 500 in particular, I would not be inclined to say that this is stronger selling just yet. To me, it looks like a pullback in the context of an overall uptrend. Let's check in on these individual charts though and just continue to look through the data. As we look at the XLY, I definitely have some concerns about the potential lower high double top getting some acceptance under the neckline. We're not there yet, but it's a very, very important watch here at 193.50. If we can hold above, bullish for the S&P. If we fail underneath, okay, maybe it's more than just a mild pullback as we've noted so far. Materials, extremely lightweight sector, not concerned, double topping near the all-time high, but nowhere close to breaking down through the neckline. We're moving along. Industrials looks like a higher low pullback over a breakout level break, higher low above, looking for continuation over time. Looks like we have a doji on today's session, a close back inside of the previous day's range. I would not say that this is overly aggressive for the bears. And notice the theme here as we're going through the sectors, right? Nothing's going to be overly aggressive for the bears. Maybe I spoke too soon, right? Here's the XLV. We do have to talk about healthcare. It is D for defensive, so it's not the end of the world to see this underperforming, but it did break down through its key sort of last pivot low, which is a retest of these previous highs from back here. In a picture-perfect world, we wanted to see this continue to consolidate here and then possibly break back to the upside. We're not getting that. We do have a hammer candle on today's session, so I wouldn't say you want to just be, second mortgage the house, healthcare sector is going to zero. But it does unfortunately lend itself to saying, okay, we have technically a lower low, a lower high can be produced if this trend is going to continue in the downward direction. Just watching healthcare. It's D for defensive, but it's also still the third heaviest weight sector. That's the balance that we always have to strike. Next up, energy. Really lackluster, not doing anything impressive, kind of trying to balance out over these previous highs. If it rallies to the upside, maybe it's slightly inflationary. Really, energy stuck sideways in this range isn't really telling us a whole lot. Energy has not done anything constructive for months now at this point, if you look at what's going on here, right? And obviously, I would expect that there might be some headwinds for the XLE, noting that if we can reject this level right here, I think it's just a very clear inflection point where sellers can step up and possibly offer a lower high. It's been a little bit wishy-washy through this level. Remember that these are geopolitical tensions, really. Tried to hold it for support, trying a higher low, back through. Do we want to trust it? Would I second mortgage the house on 72? Probably not, but just generally trying to think about the context and what's going on in the broad market. This, to me, would seemingly indicate that it wouldn't be unreasonable for the XLE to move in the downward direction, right? As we look at the TLT, I do want to bring up that bond volatility has been off the hook here. I know that's maybe a lame saying to be using these days, but my goodness, look at what's going on. Just an utter collapse in the TLT. The longer end of the curve is just getting absolutely hammered here, obviously driving interest rates in the upward direction. We'll talk about that, but my goodness, this doesn't really bode well. I'd say the longer end of the curve doing some of the heavy lifting for Jerome Powell, possibly pricing in a wave 2 of inflation. That's sort of yet to be seen, but certainly the bond market appears to be scared about that, and gold as well. We'll talk about gold in a moment. The XLC, again, let's get back to the sectors. Let's talk about the S&P 500 and generally the impacts that's here. Anything bearish to say about this chart? No, it's just consolidating near the all-time highs. XLF, the second heaviest weighted sector in the market. Anything bearish to say about this chart? Absolutely not. And once again, this is the primary reason why if you're looking for shorts, the NASDAQ's the place to be. If you're looking for longs, the S&P is the place to be. New highs, pulling back, multiple hammers back to back. You did not even make a new lower low on today's session from the bar-to-bar count. This is easily a mild higher low pullback in an uptrend, possibly looking for continuation in the upward direction. That is fuel for the bulls. Let's move along to, and I would only be concerned about this, right? Let me just be clear about this. I would only be concerned if we got something like this as a massive head and shoulders. It's not even a conversation point at this point in time. Semiconductors, what do we see over here? You are unfortunately starting to get a little bit of this action right there. I would not be bearish until it's under the neckline underneath. Oops, there we go. This 245, you're sort of holding on to that absolute line in the sand for the potential higher low. Anything that just starts chopping around through here maybe gets the market a little bit more antsy and I would say reliant, specifically in the S&P, on those financials to continue outperforming. So be mindful of that. But as we're looking at the daily structure that printed today, it's a hammer candle. Nice response from the buyers off of these lows. Recall the ASML, leak of the report back here. Not really a huge cause for concern, honestly. I would tend to think if we can break over these highs, maybe we get some sort of pushback up to the equal highs. And in theory, the best outcome would be a gap close for the bulls. We're just not there yet. So you're stuck between a rock and a hard place here on the semiconductors. You're quite literally in between, in the midpoint of both of these key levels. I would think based on the daily hammer, we have the possibility for upside, but we won't hold our breath on that. Next up, let's take a look at the XLK. Looks far superior to the SMH, right? If you're looking at the breakout level here, great break to the upside, better looking retest, stronger holds of that level both times here, longer lower wicks that pierce beneath and then close back above, pierce beneath, close back above. What does that mean? It ultimately gives the sellers an opportunity to run away with it, failing the breakout over here, but the sellers just seemingly can't make it happen. So as of right now, maintaining a more optimistic and bullish stance in the XLK if we could stay over that 228.15. Is it treading on thin ice? Yeah, to some degree, right? You have highs and maybe lower highs happening here, but I wouldn't just outright short this so long as this kind of consolidation is holding up over 228.15. And we know ultimately that we're just trying to gauge the S&P anyways. So let's take a look at the XLP. This is ideally what the XLV would have done. Obviously, we're not getting that. So sideways, nothing to write home about over here. It's D for defensive anyways. Real estate, interestingly enough, having a big up day here, even as rates also had a pretty solid day today. It's kind of a head scratcher. As we know, real estate's a lighter weight sector, so only concerned when and if it makes a new big pivot high or low. Not there yet. And utilities, the most bond-like sector, look poised for a breakout. I would have to say that this is technically leaning a little bit more D for defensive, a little bit more risk off in terms of posturing. Let's take a look at the ratio grid and see what we can see from this perspective. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. Generally, the XLK is, as we noted on the chart, it's not inherently bearish, but it's also not really pulling its weight as it should be if we're looking for new extensions to all-time highs. So kind of neutral over there. XLF looks good. That is absolutely bullish. This is kind of more neutral as well out of the healthcare sector. This is kind of bearish here, breaking to a new lower low and failing the pullback into the 50 SMA out of the XLY. So generally speaking, I would say we're kind of stuck in not quite risk on mode anymore, but not full-blown risk off. If you look at consumer staples, a little bit of an uptick here, but generally the trend is down, and utilities also on a relative basis have not broken out to a new high. If this did break out to a new high, I would say, yeah, that is a risk off rotation that's starting to look like it's developing. We're not all the way there yet, sort of stuck once again between a rock and a hard place, but I think that generally aligns with, okay, we've seen a pullback. Of course, you're not going to see relative strength on technology when a pullback's taking place, so I don't think anything's out of the ordinary per se. If we take a look at government-backed 1 to 3 versus the tech sector, still kind of sideways over here, but after making a newer higher high. So I'm okay. I would call that risk on for the most part. As we look at utilities relative to tech, this is rolling over. Once again, the idea is that we need a higher low to stick after this trend line break. So you sort of have one more opportunity to do so, and ideally we get a new higher high after that. So a little bit more neutral over here. As we take a look at discretionary versus staples, coming back down aggressively underneath this consolidation does not really give me a warm and fuzzy feeling inside. Once again, you can start to see how it's not so clear that we're still in a risk-on environment, right? If you look at this, no breakout in this ratio. This is healthcare versus the semiconductors. It'd be ideal if this could break out. That would speak to, okay, the final of the sort of pieces of the puzzle. You probably get 2 risk on here, and this is an okay look. This one's not great. You know, once again, I think that the main point of today's episode is, yes, we saw some selling pressure today. Does it really look like anything more like a bigger structural shift where, oh my goodness, markets are going to zero? No, we're not yet at the point where the market is screaming risk off. Oh my God, sell everything. People are pricing in a huge Armageddon-style sell-off. Let's go ahead and take a look at the Dixie, which is going to start to get us a little bit more towards the fundamental take, where we do have to acknowledge that financial conditions are absolutely tightening. So, although the technical indications, the daily uptrend on the S&P, the still daily uptrend on the NASDAQ, although we're intact over there, the fundamental story, it's got to continue to tie in here a little bit. Dollar ripping to the upside like this really is tightening up some financial conditions. We know that that's, of course, having to do with gold a little bit. It's having to do with interest rates. It's having to do with the Fed and the way they've been telegraphing their cuts, which are not being received very well at all by the marketplace. So this rally to the upside, it does strike me as being a little bit more bearish than bullish for equities down below. As we take a look at, let's go on over to gold. It is starting to break, or it started to break on the Tuesday session. If I just do something that looks like this, you can see how we moved over this flat top. And this is the ratio of gold to the S&P 500. When gold starts outperforming the S&P, that's when I'm more concerned about the rally here. For the longest time, as this gold breakout was sort of taking place, and like we weren't really, I'm talking about from here onward, right? This part of the rally there, we weren't really making new highs on the, on the ratio. It's like, okay, is it really a flight to safety? Not really. If this starts outperforming, though, on the ratio by making new higher highs here, now all of a sudden, again, we have to sort of take a step back and say, why would that be the case with gold, right? It's sort of more of an inflation hedge. It's more of a de-risking asset. So thinking about that perspective here with the ratio break, let's take a look at the interest rate now, the U.S. 10-year, which we've got to have a conversation about because this is like a full-blown 100% retracement over the span of just a few short, couple of weeks here. It's not even a full month. Just straight back to the upside, and kind of incredible the fact that the market is being so resilient, right? And the reason I would say something like that is because, generally speaking, the market was head over heels about the Fed cutting interest rates. Oh my God, we're going to have this soft landing. Everything's going to be fine and dandy. Rainbows and butterflies. You get a prize, you get a prize, you get a prize. Everybody has, trading accounts at all-time highs. Well, not really being well received by the market. Even though Jerome Powell has been pretty clear about, yeah, we're probably at the top of policy, the market's saying, no, you've made a mistake, my friend. So the fact that this is so counter to what Jerome Powell has been telegraphing, I think is another larger fundamental issue that we should at least be considerate of, remembering what we talked about on Saturday, that earnings estimates are compressing for 24 and 25 calendar year, and PE multiples have expanded, causing this rally to at least sustain itself up here. But I don't know how much longer that can persist for if we're getting a 10-year that's just straight back in the upward direction, right? And we had talked about just a moment ago bond volatility. Let's quickly look at the 2-year. Right, we'll go over to the inverted ZT here, which is continuing to move in the upward direction. Again, even the 2-year is saying like, no way, Jerome Powell, we're calling your bluff big time here. You're either going to do nothing in this next meeting, or like, heaven forbid, you even give a 25 basis point cut. That's kind of what this is signaling. And I also want to talk about like, where could the 10-year go and what would that imply for the market, right? We had sort of done this exercise on Saturday, but if you think about where the 10-year is currently trading, which is at 40, technically this is 4.24. Okay, so 4.24. Let's take a look at what the terminal forecast is right now from the Fed tracker tool. Just generally speaking, where does the market see rates bottoming out at? You can see over here on the 2-year, the Fed funds is going to be an echo of that, right? You've got 350 to 375 basis points. So let's call it 3.5% on the 2-year. Okay, good. Let's go back over here to the platform. Let's take a look at the 10-2 curve. All right, it looks like we're getting some bearish re-steepening here as the 10-year moves more aggressively than the 2-year in the upward direction, right? So if this is going to re-steepen and, I don't know, make it up towards like, I don't know, let's use round numbers, right? Let's use easy round numbers 2. I'm going to call for 2, right? 2 looks like sort of the top end of the 10-2 curve. It usually doesn't go much higher than that. If we're going to get back to 2, just add 2% on top of that 3.5. Obviously, that gets us closer to a 10-year yield that's sitting at 5.5. What happens to the market when interest rates are on the 10-year at 5.5? I mean, your mortgage demand is going to get absolutely crushed. The cyclical side of the economy is going to get absolutely beat up. So, these are just some fundamental concerns that are swirling around in the back of my head. Once again, the technicals always drive the decision-making in the S&P 500. That chart is always going to be king. Remember, price is what pays. But as we think about, like, maybe what's happening here isn't really all that great, there's an argument to be made, I think, from the fundamental perspective. So that's my take on that front. Let's get back on over to the Fed tracker tool, just reinforcing the idea that, we're looking for a 25 basis point cut, about 92.4% odds of that into the next meeting. Probably going to change next Friday. November 1st is the full labor report. We'll watch out for that. Here's the MOVE Bond Volatility Index. Once again, notice that bond volatility has lit up like a Christmas tree. If this is not something that you track regularly, just understand that this is pretty elevated here as you scroll back. Bond volatility, I wouldn't say it's like the VIX in the same sense that it's always mean reverting, but generally speaking, this is pretty uncomfortable, right? That is pretty uncomfortable, and it looks like we're on a fast track for that instead of what would have been more ideal, right, as the Fed comes into a cutting cycle is, okay, we know what the path is from the Fed. If everything's fine in the economy, bond volatility should actually decrease, right? Everybody can see the Fed is telegraphing what should happen. The fact that it's not happening is clearly what's spurring this back in the upward direction. So this is the MOVE index for anybody who's curious. As we take a look at the economic calendar, then we'll get to earnings. Tomorrow is a big watch. It's the main event of the week. We have unemployment claims, PMIs. Those are maybe worth watching out for, but it's really this in the pre-market session, continuing to gauge how the weather impacts are sort of impacting, not to use the same word twice, the southeast coast of the U.S. What's going on with Florida and North Carolina is where we want to be checking in on. Durable goods on Friday, not really all that important. It's all about next week, as we know. It's the full labor report, right? You get JOLTS, ADP non-farms. It looks like GDPs are coming out. You get the PCE, the ECI, hourly earnings, the NFP, and the unemployment rate. That's kind of the biggest deal. I think that this is going to move the needle the most for that FedWatch tool. Earnings calendar, here it is. Tesla after the close is the talk of the town, and as we were just making note earlier, Tesla is technically doing all right here in the after hours. IBM is something that we should check in on as well. Even Lam Research, right, from a semiconductor perspective, these are names that are somewhat interesting here. So with that, we'll go back on over to the platform. We'll take a look at a couple of these earnings charts before we move too much further through the analysis. Let's go to Tesla first, top dog. Looks like it's doing A-okay, no issues out of Tesla. Once again, that would to me imply that these upper levels, those key levels we had described in the S&P and the NASDAQ, are probably looking to get tested first before any sort of big bearish detrimental outcome. That to me is what Tesla is sort of forecasting. If we look at, what is it, LRCX, yes, there it is. This is Lam Research. Looks like we're up and away. So once again, that's bullish for the semiconductor space. Let's look at the SMH just as the ETF in the after hours, kind of stagnant and sideways. Lam's just not all that heavily weighted in the ETF itself. But let's go to IBM. and see how IBM's reporting. Oof, not so good over here out of IBM. Looks like a bit of a gap down. So some push and pull between Lam and IBM for semiconductors. Not a surprise that it's more so sideways. I would say that Tesla is your primary contender from the earnings perspective. All right, with that, let's jump into our risk appetite charts. TLT ratio to the S&P is through the floor, but once again, that's because of this volatility over here. I think if we look at bonds in relationship to themselves, they're really starting to tell more of the story that we've been talking about more manually, which is that as the longer end of the curve starts to rise a little bit, hey, it doesn't really, you're seeing this is basically echoing the bearish steepening of the yield curve, right? Which is here, here, and here. So watching out for that. These in uptrends is never usually a big bullish sign for equities down below. You want to see a sort of persistent downtrend there. So not great. As we take a look at credit spreads, it's worth pointing out that these have accelerated this week. You're starting to see some risk come back into that with the amount of volatility in the bond market and financial conditions notably tightening here. The dollar is at play for that also. If we take a look at the high yield spread by itself, or I should just say the high yield junk bond by itself, it's continuing to be divergent with the market up here. If you just take a look at this, right? If you draw a reference point here, you're technically trading at or even below that pivot. If you do the same thing in equities down below, you're not even there yet. If you take a look at the LQD, like this one just really speaks for itself. I think I'll just let it be. There's an arrow for you. You know what to do. Let's move along to the Bitcoin chart and see what's going on over here. I think that the breakout is still valid. We had talked about the Sailor Shift tool on Saturday's update. It technically triggered back to the downside, but what you would do in this instance is place a stop underneath the previous bar's low. If you're a believer that this is really going to go for it and see a stronger breakout in the upward direction, the cup and handle that we've been referencing on like even the zoomed out weekly time frame, then I think that it's reasonable. And keep in mind, this is a log scale, so this is not totally representative of a 3-to-1, but you're talking about something like a target up around 110,000 with risk down here underneath these consolidation lows. I still think that it's a reasonable trade to have in play here with the break of the resistance trend line, right? If you do something like this broke the trend line, this could easily just be a retest before continuation. Generally, this leans a little bit more risk on for the marketplace, and I would, I'll call it as it is. If it comes back down underneath that more aggressively, then hey, not really not a strong risk appetite indication for markets. Let's move on over to breadth. Breadth has contracted big time during this week's session, notably on today's session primarily, but moving averages pointing back in the downward direction, still over 50%. Most dangerous is the new highs versus lows sitting quite literally near the zero line at 22. If this flips negative, it definitely would cause it'd be a stronger cause for concern. Let's frame it that way for the S&P 500. What about the RSP equal weight? A little bit of a concern over here with the move underneath the breakout level versus the weighted S&P down below holding up above, as we had made note on that Spider's Cash ETF. So this, again, smaller cause for concern. I still think it's a pullback in an overall uptrend until proven otherwise, but you are starting to see some of these concerns, come to light here in the S&P. Let's jump on over to the equal weight NASDAQ. Same story. Pulling back to the level, whereas the weighted NASDAQ is right to, let me be careful with my words, slightly below versus right to. There you go, right? So that breadth contraction is real even in the NASDAQ and the transports, right? Our little fake breakout friend over here. It's done it once, twice, 3, 4 times in the past. Is the 5th time the charm? Looks like we are getting a bit of that fake breakout indication. So we'll keep tabs on that. If we take a look at volatility, it's drifting to the downside, but still elevated relative to previous locations, right? 15 is still holding as a floor. I would call this mild consolidation. If it ignites, hey, that seems reasonable given everything we've talked about so far. If we move along to the VVIX, VVIX is still elevated. Again, nothing really to talk about there other than volatility is sort of elevated as we head into the election timeframe. So it's not much of a shocker if volatility, ignites sort of out of nowhere in that S&P. I would namely say if we break that key daily line in the sand, you're just not doing it yet. As we look at volatility futures, you are moving into a deeper backwardation here, towards backwardation here, and you are getting an ignition out of the one-day VIX. Not a surprise given today's sell. Let's jump on over. Let's take a quick look at the skew index here just to see how this is moving. It looks like we are getting some normalization of those longer dated put pricings in terms of the implied volatility on those 30 plus days. So black swan, naysayers are sort of dialing it back a little bit, which sort of makes sense as we get a pullback happening here. Because it didn't really accelerate, I could envision that some of that stuff got closed out. Anyhow, let's jump on over to our core list of companies. Let's do the deal here and get the job done. Let's start with Apple. Apple currently larger pullback than I would have imagined today, noting some of the strength that we saw off of 233 on the Tuesday session. Let's go to the hourly chart just to understand this, right? So look at the opening drive to the downside on this small gap down. Found support beautifully off the 233 level, rallied back up basically to the all-time high. The magnitude of weakness today, a little bit surprising. I will say on the daily time frame chart, it's possible that you get lows, higher lows, higher lows. Possibility for a higher low here. I like the close above 229.50, but from an intraday trading perspective, it doesn't really leave us with the cleanest looking chart here. I would say that holds above, like consolidation here that maybe breaks above this settlement price, could get you a thin structure retracement to 233. If you're a naysayer, you might try to, reject that level for a lower high here. I think that's too counter trend on the daily for my liking, so not really thrilled with that. I would try Stevie Wonders here, honestly. Stevie Wonder trades over the settlement, thin structure retracement, targets 233, looking for continuation. If it happens, great. If not, it's sized for zero anyhow. Let's jump on over to Microsoft and talk about the big rally from Tuesday, finally resolving this ugly, ugly balance range from down here. Generally, on the daily time frame chart, I guess we can come in. It's been sort of a theme of today's video. Here's some trend lines for you. You've got this trend line, and you've also had this trend line, which is broken now. So a technical breakout, as long as a higher low can hold over, I would say 419.75. Here it is on the hourly time frame chart, just to illustrate that level. As long as we can pull back and hold above this consolidation, I think that the bulls are trying to make a stand here. The picture perfect outcome from today's session would have just been consolidation up here that did not break 425.25, that then got continuation into 435. Not the case, and until proven otherwise, I would think that this is no man's land. I would think we have Stevie Wonders possible here on Brigade bolts over 425.25. And I would think that if we do get pullbacks, I would look for long opportunities off of 419.75. It's the daily 50 and 200 SMA stacked for confluence at that same exact level. Earnings a little bit further out on this one, not a big deal. NVIDIA. Let's go to the daily. What do we see out of NVIDIA? Really, as we're thinking about the one stock to rule them all on a big pullback day for the market, I mean, yeah, on a relative basis, it's down 174 basis points, but look at the chart structure. Has it done anything to invalidate the uptrend that it's in? Absolutely not. You have lows, higher lows, higher lows, higher lows, potentially higher lows here if it can hold up over 136.50. So for the most part, leaning still on the bull side here, looking for entries that look like this, continuation of blue sky territories. If it rejects in here, right? So if we do not get the Brigade bull, if this does not happen, if we reject, I would wait patiently. Please, please, please do not. There's no need to jump the gun on the short side. Something trading at all-time highs. Let it turn into the head and shoulders. Let it break the neckline, because what that does ultimately is it brings in a new lower low in the hourly trend count. You have highs, lower highs, lows, equal lows. Let it produce a new lower low. When that lower low is produced, maybe there's a deeper pullback to retest 129.50, which on the daily time frame chart would sort of be that key hold for the next line in the sand, major higher low, right? Weekly perhaps, low, higher low, higher low. You already sort of had that liquidation break on the ASML news to the level, so, it wouldn't be great to test it again in very short proximity of time, but as a weekly hold, it would still look pretty good there at 129.50, maybe letting the daily 50 SMA catch up with price over time. So don't want to be overly bearish. I know we just ended on a pullback talk, but for the most part, this would be the primary outcome that I'm looking for. Next up, we have Google. Nothing to talk about here. Daily time frame chart really does it. Here's the balance range. Maybe it's a left, maybe it's a head, maybe it's a right. There's nothing to do until it's over 169 to potentially close this gap overhead. Until that happens, nothing. So moving along to Amazon. What do we see out of Nancy? Sharper break to the downside today, which is honestly a bit surprising, noting the strength that it tried to pick up on the Tuesday session, even Monday as well. So zooming in, recalling that this balance range was trying to build a block in the upward direction. We sort of had the look above and fail, rebounded off the bottom, consolidation. So once again, a bit of a shocker here to see that Amazon was just straight to the downside the way it was. To me, it does feel a little bit top heavy now. You have all of this overhead supply that's trapped. They were sort of, ranting and raving, and, myself included. There were some Amazon trades that we took in here. But this move to the upside has now failed. Anybody who's still holding those positions probably panics out of them on something that looks like this, lower high under 186.25. So being mindful of risk reward that possibly flips in the downward direction along these lines. If it is going to be a move to the upside, it's got to be just another instance of a look below and fail. You've got to see that 186.25 hold. I would not be a willy-nilly long in here. I think that on the daily time frame chart, we have too much of a threat of a high and a lower high. You are not pulling back anymore from the highest high in the trend count. You are pulling back from a lower high. So be cautious of pullback buys now in Amazon. Next up, Metaverse, another one, which just straight to the downside, kind of a shocker here. on today's session after a look below and fail, which had completed. Top end of the range was hit, all set. Opening in range, I thought that there was a decent opportunity for possibly a pullback, something that looked like this, and there we go. Just like Google on the daily time frame chart, Meta on the hourly chart would suggest an inverted head and shoulders. Not the case. Obviously, we closed weak underneath. So going to the daily time frame, I think that we just want to be mindful that this is a pretty key area of support. It's kind of a demand zone, and generally speaking, Metaverse has been one of the strongest names in the market. So after a almost 3% down day, do I want to be a brand new money short here? Probably not, especially after the pullbacks already sort of ensued off of these highs anyhow. I would be more of the mindset of a pullback long here on the Metaverse, not necessarily a new money short. So with that, looking for support down here. If there's any look belows and fails on like the hourly chart, Brigade bolts back above 561. Excuse me, I'm all over that. Looking for, maybe that looks like this. Break below, higher low back above on the hourly, acceptance back inside of today's trading range, then, risk, reward back to the upside. I would start looking for those opportunities, to be honest with you. If it does break to the downside, I'd just let it go. This is the biggest weekly retest I've seen in a very long time at 542.50. Just zooming out on the daily time frame chart, you can see this. Huge flat top, huge balance range that was just stuck underneath. Big break. Retest, Brigade bolt on the weekly, all aboard the long train, or at least I'll be looking for it at 542.50. Next up, we've got Tesla earnings, obviously, as we were just describing on the earnings preview, if you will. So 238.67 in the post market, which means we're gapping the gap. It's a double gap. We're opening up here somewhere. So very status quo outcomes, right? If we open on a gap up, test and fail the overnight high, looking for a pullback that supports 234.15, retarget the overnight high, the overnight high, and then look for continuation to 250. If we fail under 234.15, it's a double gap to close, looking for that full rotation into 223.40, and then today's high. I would still look for support off of this gap close. So generally, let me actually just go to this look over here so you can sort of see it side by side as I'm talking about it in kind of real time here. So notice the open up here, right? Notice the open up here. On the hourly time frame chart, let me make this nice and easy on the eyes, doing something that looks like this. We're opening up here. If we test the overnight high 240, so we test 240, fail below, looking to target 234.15. When we get to 234.15, something that looks like this, right? Test, fail, comes back down, testing 234.15. I would firstly be thinking about support here. How can we long it back to 250? If we fail underneath, if this is just a straight shot under 234, I would look for lower high setups intraday to trade for the double gap close, something that looks like this, into 223.40. When we get here, reevaluating once again, even if it's just a counter trend move, even if we roll over here into the future, I would still firstly look for support off of 223.40. All right, so those are my takes here on Tesla. Next up, JP Morgan. Let's drop this back over to this chart here. JP Morgan. Bull flag until proven otherwise. This has acted like a slug. So post earnings, financial earnings generally as a whole, just a slug sideways consolidation. I would say Brigade bolts out of the range, or just looking for thin structure retracements on a pullback into 215.75, noting the previous highs from back here. That would sort of be my line in the sand on the daily for that higher low to be produced, noting also if it happens sooner rather than later, it's the daily 50 SMA as well. Here it is on the hourly time frame chart. I think that the sellers, if anything, had an opportunity this morning, and they just completely failed to materialize on that, right? So sort of opening inside of this range after the lower high being set yesterday, it would have just taken a break of this level, and then you get the pullback to ensue, just didn't take place. So bull flag consolidation until proven otherwise. We're moving along to Netflix. Very simple chart here. Looking for the retest of the earnings open, basically, as well as the previous pivot high, 736. You are breaking down from a bull flag consolidation here, so the idea is this, but if it does accept inside of this range, the earnings gap close is also not unreasonable. So 736 is that key level out of Netflix. Simple chart. It's been straight up. It's coming straight down. I would look for interactions off of this level. Very straightforward. Next up, AMZN. What do we see out of not the one stock to rule them all, but the knockoff version, if you will? This has been a real laggard, right? So one of the things I would just call out here as we're talking about AMD is if you're looking to trade something that's strong, you want to trade NVIDIA, right? NVIDIA is clearly the winner in the semiconductor space right now. Not even talking about long-term prospects of the company, but just from a volatility and intraday perspective, the way the stock trades, NVIDIA is the place to be. AMD has proven it to us in this pullback here that it's sort of like dead in the water. Maybe earnings is the next catalyst that's going to be required to get this thing back in gear, but there's really nothing on this chart that gets me overly excited as like, hey, this is a big trade idea. So with that, I will save you the time and I'll move you directly into my one trade idea, which is PM. Philip Morris, right? I believe that they got this big upgrade. It's now being talked about, which is crazy to think about, as a growth stock with Zinn, their latest product line exploding and taking all colleges by storm. So over 131.50, and not even colleges. I think it's like business people as well. Zinn at the office, is that a thing? So over this level, right? I don't know if you saw it on the daily time frame chart. I was going to the hourly to get the level more precise, but this is just a very classic bullish 3-bar play. Right? If you could break out through the inside bar high, it's blue sky territories up ahead. There's literally nothing off to our left. This is the biggest break on PM that you've seen in a very, very long time. Let's even just go out to like a monthly time frame chart so you can see this. These are new highs. New highs, huge acceleration. This is that, quote, growth moment that's being priced in on the Zinn. So if it's a blue sky breakout, it's possibly worth trading. It's totally disjointed from the semiconductors. That's for darn sure. So if you're looking for a non-correlated return, maybe check out Philip Morris and hop aboard the Zinn train, although that is probably not a good thing to promote. Another non-correlated thing that just comes to mind because it's been acting really well recently is Walmart. We talked about Walmart on the Saturday update video or last Wednesday. Can't even get my days straight anymore, but this balance range has ultimately broken out, so solid trade here in Walmart for anybody who is participating. The next idea would just be, again, not correlated to semiconductors, but if it does pull back and he holds over this breakout level, probably looking for another higher low opportunity at 81.50 down to about 81.10 as a little zone there. So that is going to wrap up today's episode of the Midweek Market Update. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a thumbs up. Felt a little bit rambly, felt a little bit ranty today, specifically around some of that fundamental conversation. Give me some feedback. Do you like that stuff? Is it like, shut up, Matt, and just talk charts? Tell me about the technical levels. Do you like the fundamental take? Do you like it when I tie in kind of what's happening with interest rates? And I'd love to hear your feedback, right? It's always a journey to get better and progress the show. There are things I think are worth talking about, but if nobody wants to hear it, then I'll just keep my opinions to myself. And with that, I will conclude today's episode of the Midweek Market Update. I will see you in the next one. Hopefully we catch you in tomorrow morning's pre-market prep live up in the penthouse. 8 o'clock we kick off the show. Unemployment claims come out at 8:30. We'll see if we have coffee and donuts for that release. We'll see you there. Have a green trading week, and I'll catch you in the next one.